Welcome to MDV, The Blueprint. I'm your host, Michael Dellavella. Today, I have a wonderful guest who is also a good friend. His name is Steve Weixel with Guaranteed Rate. And Steve and I know each other pretty well, so hopefully this will give everybody a good indication of what's to come with this podcast, but it's going to be a lot of fun. We will definitely rekindle old stories, give some great advice. Steve is a brilliant mind, and I think he's going to add a lot of value to the show. Without further ado, Steve Weixel from Guaranteed Rate. My God, Steve, how the hell are you?
Doing great, Michael. How are you?
I haven't seen you in a while.
You know what is that? I mean, it's funny. I see people less face to face these days, and I'm kind of a little bummed out about it. I like having a physical location. I work out of an office, but you know how business goes these days. A lot of times it's phones, it's emails, I do videos with people, and there's a lot of it online. But yeah, you're right. I need to catch up with you, get a little face to face. I'm glad to be doing this.
Yeah, this will catch us up. So catch me up. How are the kids?
Kids are great. They're getting bigger. So I got everyone's spreading out. They're coast to coast these days. So I got one left in high school, my youngest guy, but my oldest is New York City. I got three daughters, then two boys. My oldest is in New York City. My second daughter's a nurse in Columbus. Charlotte just graduated in from WashU in St. Louis, and she's heading to medical school in California. Then I got a boy at Ohio State, like your boys, and then my youngest is going to be a senior in high school.
So you probably have not heard any of this stuff. So Johnny's home temporarily until he moves to New York and pursues his dreams. Luca, but I mean, thank God for Johnny. Without Gianni, I couldn't do any of this stuff. But Gianni just is finishing up a short film that he is starting to enter in a lot of the film festivals, and it's
Really?
spectacular. We'll have to send it to you. Dante moved to Norway and took a job in Norway. Did you know that?
I haven't heard this at all. No.
He took a job, and I'm trying to find the name of the company right now. I'm scrolling on my
I
phone.
I was proud of my kids coast to coast. Look at you going worldwide, Delavella.
Oh, it's hard, but Laura went down with him. He's been there about a month, and it is so gorgeous. The pictures that he sends and the videos that he sends. Laura got him settled. She was there for a little over 2 weeks.
Well, that's exciting. I mean, that's a big deal, and good for him breaking out and finding his own
Takes
path.
guts. Takes guts. And then Luca has one more
Does.
year at Ohio State. And then other than that, we just are back. Laura and I are back to the grind. It is, while I would say it's a market a housing market that everything sells. It's challenging. There's no inventory. There's nothing to buy. Nobody wants to sell. So let's dive into this and talk about. Well, first, tell me about Guaranteed Rate. Guaranteed Rate.
Well, guaranteed rate, as you know, I was with your company on the lending side for a dozen plus years, and even longer in another form before that. So I've been in the business 25 years. Guaranteed rate. I just started up this branch on the west side. We opened up an office in Rocky River, right by Market, and a great location. And obviously we lend anywhere in Ohio, but we're really focused on the west side of Cleveland. But guaranteed rates is based out of Chicago. Depending on how you measure it, we're the second or third largest in the country for direct retail lending. We're based out of Chicago. Chicago White Sox field is guaranteed rate field.
I
If
didn't know
anybody's
that.
familiar with that. But yeah, it's a terrific company, and we're really based on realtor relationships, really relationships with professionals. We're not about, we don't focus on the direct to consumer, though we do offer it obviously, but 100% of our business comes from retail, and most of it comes from relationships. So working obviously with individual agents and teams like yours, and helping customers get into homes, all different types, conventional, FHA, VA, first time buyers. A lot of really interesting products coming out too to help support things like reverse mortgages and things like that that are kind of nichey, but really useful. And we can talk about that later if you want. But it's just a very, very great company, and We're really built on speed and professionalism. We're super fast. I've never been in a faster place.
Let me ask you a question first. Is it different because your career was you were in an office with Howard Hanna in Rocky River, and at any given time you could have 20 agents in the office that may need you. Um, you had a pool that you were working with. Is it easier, harder?
It's just different. It's different. I'm really excited about. I understand what you're asking, and I'll always be thankful for my experience at Howard Hanna and with Howard Hanna Mortgage. Very good people there, both in agents and all the support staff, and on the mortgage side, great people. And it was a great experience, and it was a lot of volume. It gave me the opportunity to see. There's no substitute for experience, and I'm thankful for my 25 years, and for all the different opportunities to not only be able to help the clients, the home buyers, getting them pre-approved and getting it done, but knowing intimately what an agent needs as far as communication goes and their concerns, and just making sure people are on everyone's on the same page and we make it as smooth as possible. But yes, it's completely not completely different, but it's just different. It's not better or worse. Being with what I had the ability to do now is obviously I know there were a whole pool of very talented realtors that I never really had the opportunity to work with directly when I was under one roof. Because if you're with another real estate company, who's going to refer somebody to Howard Hanna Mortgage? That's probably not going to happen for understandable reasons. Now I get all of these other agents that I saw on the other side of transactions for so many years. Now I have the opportunity to be introducing myself to them, introducing guaranteed rate to them, and hopefully building relationships so we can help their buyers, and help them grow their businesses and help their buyers get into homes.
See, that's great. So I'm going to piggyback on something that you said. So you did leave Howard Hanna for a while. You went into a different industry, and then you got back into the business. Did you find that when you got back in and you were now in a new setting, a new environment, that it ignited that passion that, well, I'm going to get back at this, and I'm going to start making my calls, grabbing coffee with somebody, taking someone to lunch, and start building relationships that everybody can get stale in this business, and you take a lot for granted. But it sounds like to me that you hit the ground running when you restarted, and you rekindled relationships and built a lot of new ones.
Right, and I'm still building. We're looking not only to build relationships for my own originations, but also looking to, we're still looking for more other loan originators who are looking for a great opportunity with a great company because we want to build our presence more on the west side of Cleveland. So because we're still for as big as we are nationally, we're still establishing as a company our presence here in both the Cleveland market and then in Ohio in general. So, and in fact, we have a long time. The number one loan officer in Ohio is with Guaranteed Rate. We know we have a successful platform. He's out of Columbus, Jason Harris, fabulous agent, fabulous loan officer. But yeah, the excitement is real. Coming in, knowing I have a great platform, and yes, rekindling the old relationships, but building new ones. And to tell you the truth, there was a year and a half I was out of direct origination. I had a non-compete when I left, and I honored it. But I didn't leave the industry. I was in a real estate related business, as you know.
I
I was
do.
with Sherry, and she has a real
Yeah.
estate coaching company. So I worked with her and helped too. And it was actually very educational for me because has a national company, and we dealt with agents all around the country, helping them build their businesses. And that exposure and that experience for me gave me a little bit different perspective, though I feel like I've always had an understanding of what agents have to deal with. Seeing how other agents in other companies and other markets, how they do things, it opened up ways, an understanding that was, I think it was a very valuable experience. But I'm a mortgage guy. I'm a numbers guy. I'm a mortgage guy, and I'm glad to be here.
Steve, are you seeing a lot of challenges today in our current market?
Well, the challenge is activity, generating activity for understandable reasons. There's light inventory. There's for about 8 years, the interest rates were historically low. So there are people that do have a financial disincentive not to list their homes because they're in with holding a mortgage that have a relatively low payment that you couldn't replicate today. But as far as lending goes, it's better than ever because it's not in the volume but in the process. We have all the same products and more, and our capability to make it easy on the client is so much better because of technology. Our company had the first digital mortgage that was ever rolled out, and we've done nothing but improve it. So we have the speed of people being able to apply online, which isn't exclusive to us anymore, but we're very good at it. And people apply, get notified right away. We can do digital verifications of their income, of their assets. In the right situations, we don't even have to do an appraisal. We'll just value the home. It's just the process is terrific. The challenge in today's market is, first time buyers they're not giving anything up to move into a home. So they're a great opportunity because interest rates. I'm going to jump ahead and say people often ask me about what kind are rates high. Like, what do you think about rates being so high right now? I constantly counsel people, rates are not high. Interest rates are not high right now. They are relatively high when compared to a 7 or 8 year historically low period. But interest rates right now are historically normal. Interest rates have been tracked since 1971 by Freddie Mac. And for the first 39 years of being tracked, they were never below 5%. Not once, not for a single day. So, and most of the time, if you look at a chart of interest rates, we're right at the level that's kind of normal most of the time. I mean, in the 80s, they were double digits. I mean, even up to like 18% or so. A 6.5% rate, which is about where we are right now, is a very, very, very normal interest rate.
Strong.
So the question isn't, and the great thing is as Warren Buffett says, a 30-year fixed rate mortgage, and he wasn't specific on rate. He just said the concept of a 30-year fixed rate mortgage is such an opportunity. It's one of the best investment opportunities to have because if the interest rates go down in the future, well, then you can refinance. But if they go up in the future, the bank is stuck with you. They can't take that rate away from you. So really the question is, I always tell people, it's not where rates are today. They're just a factor in the math of calculating what you have available to you. The question is this a home you want to own, and is it affordable to you? Or is it a comfortable financial decision for you? Because it can only get better moving forward.
That was so well put. And it was absolutely brilliant. It was brilliant. And wow, there's a lot to take from that. A lot to take from that. So if I'm hearing you right, what advice would you give if I'm your first time buyer? Am I going to go with a fixed or a variable rate? What are you suggesting to me?
99 times out of 100, you're going to go with a fixed interest rate, partially for the reason that I just talked to you about. But, there are limited circumstances where I would advise it for somebody. I just closed a loan for somebody who wasn't a first-time buyer, but he took a 5-year ARM. So it's only fixed for the 5-year period of time. But he did it very specifically because he's a business executive. He just moved into town. His career history he's kind of a fix-it improvement guy. He comes in for 3 to 5 year stints, and he will end up going and heading up another company in another city in his industry. That's been his track record. It's what he fully anticipates doing. So he had a very specific purpose where that did make sense to him. And frankly, the difference between a fixed and a variable rate, I mean, you're not talking about cutting your payment in half. You're talking about maybe 0.5% difference in rate, maybe 1%. For most people, the certainty of a 30-year fixed rate mortgage is probably your best.
Keeping the payment low, you can refinance if rates go down. Over my career, your career, refinancing was a huge business for you guys. When do you think you'll start seeing stuff like that again? And I know you don't have a crystal ball, but would be
I
your
don't
best?
have a crystal ball. I can't guess. And here's why. If I knew when and where interest rates were going to come down, I wouldn't be a loan officer. I would be on Wall Street and I would be a billionaire. Nobody knows. It's people, there's macroeconomists, which I'm not, that disagree and agree like all the time. I mean, there's economists that every single day, every single week, every single year, they make their predictions, and 50% of the time they're right, and 50% of the time they're wrong. I mean, how many years, when you and I were working under the same roof, how many times did the CEO of our company stand up at the end of a year or the beginning of the year? Well, for all those years where interest rates were 3% or 3.5, and they would stand up and say, "We're projecting that interest rates are probably going to move to 4 or 4.5 by the end of the year." And for
Mhm.
6 or 7 straight years, they never moved. So nobody, and this is somebody who's very invested in that answer, and who's very. It's not just an off the cuff, um, prediction. There's NAR economists, Lawrence Young, everybody else. They make these predictions. Nobody knows when mid-level banks are going to have failures because of a capital liquidity crisis, or nobody knows when there's going to be a war in Southeast Asia. You just don't know what's going to happen with the market. I always tell people I don't know which rates are going to move, but the structure of a 30-year fixed rate mortgage means, number one, you don't have to worry about it. Your interest rate's locked and you're not going to have to move. And when the day comes when they do go down, well, then you can take advantage of it. It's great.
To follow up on that point you just made, is there a rule of thumb that you advise your clients when you refinance? If you're locked into a 6.5, where would be the number that time to refinance?
Here's the interesting thing. It depends on your loan size. Because you'll read online that says there's a 2% rule. If the interest rate goes down by 2% or more, then you should, if it's any less than that, don't refinance. Well, that might be true for a $100,000 loan, because I'm just going to use round numbers here. Let's say, because there's a fixed number of closing costs that are involved in most refinance transactions between the underwriting fees and the appraisal and title company costs. Let's just call it $4,000. Um, if you have a $100,000 mortgage, if you drop 1%, you're saving $1,000 a year. Well, you'd take 4 years to break even on that, and it might not really be worth it to take those costs. But if you have a $500,000 mortgage and you drop 1%, you pay back the cost of your refinance in less than a year. In that case, I would tell you absolutely. You don't have to wait for 2%. 1% would do it. Um, we even offer loan programs that refinance people at no closing costs. Um, and I can talk about that for another minute if you want to know just kind of how
No,
that works.
this is so. I find this so fascinating that I'm learning a lot. And again, I've been in the business, but you just put it so simple and just it's so well spoken that it's easy to get.
Okay, well, good. Then let me explain just a little bit further. There have been markets where I've actually refinanced people 2 and 3 times in a 12 to 18 month period because the interest rates kept falling. And the reason that made sense, there can be you have to be careful not to incur closing costs so much, because then you're adding up to the balance, but you don't have to. There is a mechanism that any mortgage lender can use, if as long as they allow it. You're familiar with buying points to get a lower interest rate,
Yep.
right? So most people are. The funny thing is the same thing works in reverse. You can actually increase the interest rate a little bit, and we'll give you points to pay the closing costs. So if I have, and again, this works better with higher dollar amount loans than lower dollar amount loans, because if I give you 2 points to pay your closing costs, a $300,000 loan is going to have 6,000 sitting around rather than only 2,000 for a $100,000 loan. Anyway, let's say you have a 7% interest rate, and they go down to 5%, and you have a $200,000 loan. You might say, okay, well, the break even on that would be 2 years, because I'm dropping 2% or a year. But you might say, instead of giving you a 5% rate, why don't I just put you in a 5.5% rate, and I'll pay all your closing costs for you? Well, that makes the decision a lot easier for a borrower. There's no risk in that. They just move from 7 to 5.5, and they keep the same principal balance, and they're just swapping out one loan for another. So I will love to have that explanation and give it to people more when we're in that market, which we're not in right now. But when the day comes, if you're listening to this and you can want to think in the future about what your refinance options are, understand that there are options and there are different ways to structure it. And when you talk to a lender who has those tools and is willing to discuss them with you, it'll give you choices.
Yeah, that was so well said. So well said. Today again, the challenges with me, like with you, is just there's no a lot of people do not want to put their houses on the market, and when they do go on the market, I mean, I know you're hearing this. It's just insane the amount of offers, and I would say stupid offers. Sometimes some bad advice, but the amount of cash deals today, last year, and the year before, it's crazy. You have to be hearing this.
Well, the values are up. They've been up so much, even if they've flattened, say, in the past 6 months or more, 6 months, 12 months. The cumulative increased equity, there is $11 trillion in untapped equity in the country right now. So there's a lot of equity in existing homes. So there's if somebody is a move up buyer, or move down buyer, if they are a seller, they've sold their home, and they're looking to get into a new home. Um, there's a lot of people with large down payments or cash down payment, or cash
Unbelievable.
down payments. There's no doubt. And besides just people's the stocks over time are still after a pretty historic run up.
What are you doing anything special, specific to help your clients try to win bids?
We speed. I mentioned it earlier. One of our strongest. There's two different things that I end up employing a lot, and it makes sense for any buyer, whether they're a first time buyer or whether they're a repeat buyer. Being pre-approved ahead of time and having the ability for us to commit to a short closing time. That's how we compete with cash offers. Um, you know, by law, we can't close a transaction earlier than 8 days after loan application. Um, but I've done that. If I can have an appraisal done in the same week if I need to. We can have everything. But I submitted a loan application for somebody on Monday afternoon, which this is a Wednesday morning we're speaking. I've already gotten the loan approval back out of underwriting. So we're going to be ready to close that very, very quickly. So there's no disincentive like there used to be for most financing products that we offer, saying that you have to wait 30 or 45 days. The speed is a good combatant to that. And one of the other things that I think helps create offers and gives current homeowners the ability to be able to move forward with making a home. There are bridge loan programs available, but also we offer a recast option for people, which makes a lot of
One of my
sense.
notes to
So
ask you about recasting. Please dive into that.
I'm doing one right now. If you're not familiar, recasting is the ability to take out a loan with a smaller down payment than what you eventually want to put down. So you will purchase a home, you'll put just your 5% down or your 10% down because that's what you have liquid right now. But once you sell your current home, you're going to generate another 50,000, 100,000, 150,000 that you want to put towards whatever loan you just took out. You're still going to be left with a mortgage after the fact because you don't want to pay all cash for it at the end. But we will allow somebody to close their loan, and then once they apply a lump sum down on it, we will recast, which means recalculating the monthly payment based on that new lower balance. So it's giving them in the end the loan that they always wanted. They just hadn't sold their home yet.
If I'm a client of yours and it's my first house and we've made applications, what are you advising me not to do before we close on this transaction?
It's a really good question. I have this conversation a lot, but whether everybody understands it is another question. You know what most people do? Most people do. You try and besides giving advice about the best loan program, or you give advice about all the steps they should take. Warnings are valuable. Things not to do. You know, and this can be during the pre-approval stage too. Maybe they haven't even found a home yet. Giving people buyers the advice of things to do or to not do that will put them in the best position. The first is don't deplete your cash. There's a lot of buyers, and it's understandable. They assume that, oh, I want to get rid of that credit card. It'll help me to qualify for a mortgage because I won't have this debt. Well, you know what? I mean, sometimes we want to see cash in the bank. Depending on a person's situation, it might not be the amount of debt that they have that's the issue for us or the close call. It might be the amount of cash they have in their bank account. My first advice to people is don't make any moves with your cash until you've spoken with your lender, because cash we can do whatever we want with. We can either leave it there, or maybe the advice is to pay down a debt. Once you pay down the debt, that's where the money is. I can't undo that. So the first thing is don't make any moves with your debt until you've spoken with a loan officer. They're going to let you know qualification wise, and then for your own comfort level, what the best next step is. The second thing is using credit. Like don't establish new credit. That's either employing current credit cards or debt resources that you have. The advice would be don't utilize them. Definitely do not do things once you're under contract, like taking 6 months, same as cash, out to buy furniture, to get a fence, to do anything like that. I know you want to put that in motion and you want the appliances to show up, as you're moving in. Unless you get the clearance from your loan officer first, the advice is don't just do that without checking.
Most of the people do take that advice, but I've had people that right before close, they leased a very expensive car, bought the furniture before they moved in, and the loan falls apart. So
I have it with somebody right now. Thankfully, we have a solution for it, but the new payment went from on their car went from 600 a month to $1,600 a month. And it it made us double check things. And the other thing is obviously employment. You don't want to necessarily change and make any major changes, any type of change. Don't co-sign on a loan for a child. Don't co-sign for a parent. Don't change your job. I've had 3 people, because lenders do recheck employment, within 5 or 10 days of closing, to make sure that you're still employed. And I've had people verbally verified, and they put in their notice, and they say, well, I'm not leaving that job until after the loan closes. I'm like, but the likelihood of continuance just stopped. So we have to wait until you have a new job now.
yeah, it's amazing how much of that happens, and I try to educate everyone I work with as a buyer that please don't do these things. Don't do these things. Close the loan. If you want to quit your job in 6 months after that, that's your business. So, Steve, do you see a mortgage crash or crisis coming, like some people, and I'm not in anyone in particular, that there's a lot of negative news out there. And I'd love to get your feedback if you've heard anything like that.
Well, I think it's on just a lot of it comes down to a whether would affect anyone personally or not is probably a very individual situation. Whether a crash is coming or not probably falls under the same category of what direction are interest rates going. Again, it's more of a macroeconomic question that economists don't have the answer to for certain, and I certainly don't, sitting in Rocky River, Ohio. I will tell you that um, there's probably reason for someone to um, not over leverage themselves if they sit there and they think, okay, maybe housing values have peaked because they haven't gone up in the last several months. But then again, home values historically have gone up. but at a little more reasonable pace than they had in the past. When a crash comes, that offers opportunities too. If home prices come down and banks respond with lower interest rates, that might create an investment opportunity. Like I'm not giving a very good answer because I just don't know.
All right, let me give you my. Let's just have a conversation on it and see if we can get that answer. So I get asked all the time, when do you think this housing market is going to crash? And prices can't stay where they're at. My answer to that is, I don't think it can crash without a ton of houses on the market. It's the old supply and demand. I also think
That's
that
a very good point.
our market, the Cleveland market, was very, very undervalued. When you could buy houses for 100 to 150 for a real nice house in some areas a foot, that's insanity. And then now what they are, I just think we caught up to where we should have been. I don't think we ever had a great appreciation every year. And again, after COVID and the rates went up and nobody's selling, how can we crash? I mean, they've tried to stop inflation by raising interest rates, right?
Right.
It and I think, again, I don't know the numbers, you know them better than me, that inflation is coming down, but the housing market never slowed down.
Yeah. As far as the values,
As far as the values didn't slow down. If a house comes on the market, it's selling.
and the number of transactions has come back a bit. But yeah, to your point, the values have not, and because there's a shortage of inventory, and we're talking about this is a market condition right now. So I do agree with you in the short term. I guess on a that that I don't see a crash. And the good news is, if you're just going to even look at it as opposed to what was considered the last crash that we saw in the
2008.
oh 07, oh 08, when this is we are I want to be perfectly clear, we are not looking at that situation right now, and I'm comfortable saying this even though I'm not an economist. The the last time the housing market kind of went haywire, it was because the quality of the mortgages that were underwritten for a year were garbage. People got loans that should not have had loans. So the entire housing market was inundated with garbage loans, garbage borrowers that inflated prices, drove things up, and then it was a house of cards and it fell apart. If you've ever seen The Big Short, watch.
Oh,
If you haven't seen The Big Short, watch it because they absolutely got everything right. And they pointed out something that people don't talk about most of the time. It was how the bond rating agencies that bought all these mortgage bonds, gave them AAA ratings, and they totally abdicated their responsibility because everything in those bonds was garbage. So I love that they pointed that out in the movie. But the crash that came from that realization will not recur right now. All of the financing that's been put in place for the past 12 years, 13 years, is very well underwritten, very well qualified. Everybody's income is actually verified. Everybody's credit is at a higher level than it used to be. All of the assets are verified. So the quality of the debt that's out there isn't going to cause a crash. And to your point, the supply and demand, there hadn't been as I think we're seeing more construction now because I think the building industry has finally caught on to the fact that we're way under.
way under.
We don't have a lot of inventory. But yeah, for the time being, I would bet, in my inexpert opinion, that values are not going to come down.
So here's something interesting. Try to see if we can get an answer to this. A house goes up for $350,000. The market, and that's those are the numbers. It normally would have been a 290 house, 285 house, 350, and it sells for four and a quarter, 450. A lot of people are putting a full appraisal gap, which again, I don't know where you fall on it. I think that's foolish, but it's out there. But a lot of these are appraising, and until recently, in because of the lack of inventory in some cities, when people would sell in January, February, they're actually penalized because the appraisals were there was nothing for them to appraise it to. There was nothing in
Right.
that price range. And that to me is a problem. I mean, you can't penalize a person for selling in January because in 6 months there was nothing that sold in that city.
You bring up a very good point. Yeah.
And again, in our industry, I think it's wrong, and I don't know how to fix it. We need to collaborate with lenders and realtors and appraisers.
Here's the thing. As I said, you bring up a very good point, and there is, if you run into that situation where there's limited comparables, because every appraisal typically has three or more comparable properties that they make a comparison to develop their the value, and they should be in the proximity to whatever home is that's being appraised. It should be similar size and style and age and things like that. You're never going to get it exactly right, and appraisers make adjustments for any differences, so that's very normal. And to your point, the early January ones do have less transactions very often from November and December to make that comparison. Now, appraisers can go back 6 months or even 12 months with justification to find comparables. So you're usually not at a loss for comparables. Um, but when you mentioned the fact that people are bidding way over the original listing price, that's been a strategy for many realtors is to underprice it to create the feeding frenzy.
It's my strategy.
And if it does sell for 420, if it goes over by 50 or $70,000, um, the fact is that might still be supported by recent comparables. That might have just been the listing strategy. So here's what I tell people, when that happens. They number one, they're going in fully aware that the home might not appraise when you're bidding that much over.
Hmm.
And it's especially if they're already accepting in advance an appraisal gap feature, they're willing to make that difference up. There's a couple things. Number one, it still might appraise. If it doesn't, that doesn't mean that they can't purchase it or that they can't finance it. In fact, there's ways to overcome a short appraisal that doesn't mean if it appraises, let's say you have a $400,000 home and it only appraises at 370, you don't need to come out of pocket very often for an extra $30,000 down payment. What the lender is going to, let's say you were putting 20% down on a $480,000 home, so you're borrowing 320. If it appraises 30,000 light, we're not going to tell you to bring another 30,000. What we would tell you in that case is, okay, we're only going to value the home at 370 and you're borrowing 320. So now in our mind, you only have somewhere between 10 and 15% down payment. So we're going to require mortgage insurance. And you say, but I don't want mortgage insurance because I was putting 20% down. And we're like, okay, well, you can buy out the mortgage insurance for, you know, about $4,000. Well, buying out the mortgage insurance is way less expensive than coming up with an extra $30,000. So that's probably a simple solution in those cases. Each case is unique. You may or may not be able to buy it, depending on the loan type, depending on the numbers involved, things like that. But if you go in with your eyes wide open, you might have to come up with extra down payment, but there might be other solutions too. If you're willing, I always tell people, let's say you're not overbidding for a property. Let's say you just really pick a normal, it's listed for 350, your bid wins for 350 and you move forward. There's still a chance because that home gets appraised at $330,000. The appraiser is an individual human being. They It is a subjective value that they're giving to a property. It is based on their training and it's based on their license, but they have some subjectivity involved. So they may come back and say it's worth $330,000, not 350. And the lender is bound by that. We can't, we could challenge it if it's egregiously wrong. That normally doesn't work. The whole all of this is a protection that was built in and enhanced as a result of the crash that happened in 2008. Lenders, loan officers, I am no longer allowed by law to talk to an appraiser for a deal in process. If I talk to that appraiser, much less try to influence the value, it's a fifth-degree felony. So the system has built in protections for the lending community to say that the value that's going to come back from the appraiser is a valid, independent judgment. But if it what I tell buyers are when they come in with a short appraisal situation though is they say, look, this is the value we have to base our lending on, and we have to make whatever adjustment is necessary. But that doesn't mean the home is only worth 3,000. Four other parties, you as a buyer, the seller as a seller, and two other agents have all agreed that 350 was a reasonable price. We just have to deal with this number and overcome the little speed bump. And there are usually solutions. The home is worth 350,000 to you. The seller agreed upon that price. Let's find the solution. Don't blow up a deal because of one person's opinion.
So is this something that can be done with every lender? Is this a guaranteed rate thing?
No, most lenders should be able to accomplish it. Yeah, I mean, there are other situations. It all depends on loan type, and I'm going to get this could get too complicated, so I won't get into it. Conventional loans typically are more flexible in the
Okay.
different solutions. An FHA loan, a buyer has the right to walk away
Mm-hmm.
from a transaction if it underappraises. They usually won't. You find a solution then, but there's doesn't have those mortgage insurance ways to buy it out available. And a VA loan, actually, you get to challenge the appraisal ahead of time on a VA loan, so that actually has a protection in a buyer's favor. But on the conventional side, I usually advise buyers up front to say if it comes in as a short appraisal, here's what usually happens. The seller usually comes down to the appraisal price. You agree to come up with extra money to make up the difference, or most often you meet somewhere in the middle. But that's a conversation to have with your agent.
That was so brilliantly put, and there was a lot of information to unpack there.
I know. I'm
That was
sorry.
good. No, that was great. That was absolutely brilliant. So you kind of mentioned it, but here's a question that I have curiosity with. Conventional, it's the norm. Are you doing any FHA or VA anymore?
Sure. Yeah. We have an FHA transaction going right now. They're fantastic products, and this has been going on for years, Michael. This isn't anything new to this market, but there are situations where I still have agents, or I'll still have other people in the industry, or I'll have buyers like they get concerned about, oh, I hear FHA is frowned upon. That shouldn't happen. All of those products are all 99% identical twins. There's just little differences at the edges. An FHA buyer is not a challenged buyer. They're not a bad buyer. There's some flexibility that we can have with FHA that we don't have with conventional. It's a little more lenient on debt to income ratios. It's a little more lenient on credit. There's a VA transaction is fantastic for a veteran. They can get in with zero down payment. And, if they're a disabled veteran, essentially there's no other fees on top of it. The monthly mortgage insurance, that doesn't exist. So the there used to be very big differences in appraisals for FHA. There used to be a lot of things that FHA would not allow that conventional did. That has been lessened. There are still a few things. If there's outside peeling paint, it's usually going to have to be addressed with an FHA transaction where it probably wouldn't with a conventional. You hear sometimes about hand railings needing to be up. That's not a big deal, um, and a couple of little things. But for the most part, the things that appraisers, either with FHA or VA, the things that get cited that need to be done are health and safety issues. And frankly, if there's a health and safety issue with the house, number one, you'd want it taken care of. But number two, a conventional appraiser is going to note it too. if there is a hazard in the home, or something that's incomplete, or the kitchen is not functional, it doesn't matter what load type you have. It's going to be cited and it's going to need to be addressed. So don't dismiss. I think you're lowering the potential buyer pool, and so the competition for a listing, if you limit it to just list the conventional homes, you're keeping out the FHA buyers, which actually might end up being the best offer that your seller gets.
And again, when I represent a seller and I've had everything, there's a couple times that FHA buyer was the best buyer out there. And so I agree with you. And I happen to be a huge fan of FHA. I'm a huge fan of VA loans. I do agree with everything you said about the FHA appraisal slash inspection. It's not what it was. And
It
so
used to be
I'm glad
so
it was
restrictive.
brutal. Yeah. I mean, you'd have a laundry list of, on top of what you had to fix on the inspection, and would come back on the appraisal. So it's so glad to hear you say that. But there was a short period of time where it was like, I have an FHA buyer, and if the lender would defend the buyer, and the agent would stand up for the buyer and talk why they should do that. But some agents just we're not having it. No, we're not going to deal with that.
And the thing is, FHA has interestingly, there are different considerations in a payment, because FHA always has mortgage insurance, whereas conventional, once you get 20% down, it doesn't have it. But FHA, I'll just give you an example. This is only just a current market situation, but right now the interest rate is significantly lower for an FHA loan than it is for a conventional. So there are advantages to a buyer that doesn't necessarily mean that that buyer is a challenged buyer. And once you have a pre-approval from a reputable lender, you should be confident in that anyway. Um, I guess the end point is, don't discount an FHA offer because of your fear for an FHA appraisal. It's really 99% the same as a conventional.
See, that's such good stuff. Um, are there any, and maybe you've talked about this, and I just had it down as a question. Any first time buyer tax credits
All the time.
all the
It
time?
is it is 100% my favorite loan product. I love first time buyers. Never mind like the excitement, and never mind the fact that this would be in any market. I love first time buyers. Today's market, it matters because they don't have that concern of a house, to sell too quickly and then you're out of a home, or any of those dynamics. A first time buyer is making really what I think home buying is all about, is they're making a life decision. People talk about rates and numbers and budgets and things like that. At the end of the day, buying a home is about improving your life. The 99% of the time you're doing this because that's where you want to live. That's where you're going to spend your time. So first time buyers are doing this for the first time, and it's amazing. They're excited. We make sure they make good decisions, and frankly, lenders won't let you make a bad decision. Like, we won't lend to you if you try and overextend yourself. So it really comes down to your own comfort level, and the comfort level gets way better with these first time buyer programs. There's a lot of availability to this. There can be a little bit lower rate for people who are first time, first responders or nurses or things like that. The two main first time buyer programs that get employed the most are down payment assistance. If somebody doesn't have the down payment at all, there is a state of Ohio program that we offer that will give the down payment to you. And it's a grant. You never have to repay it. The the main one, though, I would say most people, because down payment program, you can get in with as little as 3% down payment on a conventional loan. Most of the time, buyers have at least a 3%. No matter what their down payment is, the most beneficial program, as long as they income qualify, is a first time buyer tax credit. The first time buyer tax credit can earn somebody $2,000 or more per year that they claim on their tax return with the federal government, because it's really a collaboration between the state of Ohio, Ohio Housing Finance Agency, the IRS, and approved lenders, and we're an approved lender. Most banks and mortgage lenders are not able to offer this program. You have to be approved, and IM and guaranteed rate is. But what we do is we qualify somebody, and then they will, when they file their taxes, It's not, everybody knows that you can claim a mortgage interest deduction, but right now the standard deductions are so high, especially first time buyers, they normally just take the standard deduction. This is not a deduction. This is a credit. It's like withholding money from your paycheck. If you qualify for a $2,000 a year tax credit, if you're used to getting $1,000 back on your tax return refund, well, now you're going to get 3,000. And that works out to be $166 a month. That your housing payment effectively just went down. You're still making the same mortgage payment, but you're getting $166 a month of it back in cash from the IRS. That is a significant savings. And the interesting thing is I run a printout and I show it to buyers when I'm showing them the power of this program. Let's say your interest rate actually is 6.5%, like it is today, approximately. By the time, if you're borrowing $200,000 at a 6.5% rate, by the time you do a $2,000 a year tax credit, if you lower your loan payment by $166 a month, just to show the net effective cost once all this is said and done, that effective rate is under 5%. You can't find that anywhere in today's market. There's no fixed rate that will give you the benefit of a 5% rate. So that program makes homeownership more affordable. It is a huge financial benefit, and it is always the best loan program for somebody if they qualify. And the thing is we think there is an income limitation. You can't make too much. The basic qualifications are you can't have owned a home in the last 3 years. So we call it a first time buyer program, but it's really you can't own a home in the last 3 years. So if you owned a home a long time ago and now you're still a first time buyer. You're considered it again. Veterans are always considered first time buyers. Doesn't matter if they own a home right now, they are considered first time buyers. And you can't make over a certain amount of money. It goes anywhere, roughly speaking, about $85,000 a year to $120,000 a year, depending on where the home is located and how many people you have in your household. But $85,000 borrower, if you're a first time buyer, that's a good amount of money. And they can buy quite a bit of house. They could buy a $300,000 home, hypothetically, with that kind of an income. And they're going to get they're going to get a tax credit that's well over $2,000 a year. I won't get into the math of it, but you can go as high as like $3,500 a year or so. It's really incredible, and I love talking to buyers about it.
Again, you're killing it. So, how about secondary homes, second homes, vacation homes? Is that?
I've seen them disappear, frankly. I don't see them
I,
very often. People aren't buying second homes as much in Cleveland. But if, there was a splurge there where, like in places like Vermilion or Sandusky or other areas, I would see that. Number one, we're not really a second home market, but I will tell you nationally, the market's changed because Fannie Mae and Freddie Mac, who are basically they make the rules for mortgage lending, for lack of a better way of putting it, for all conventional mortgage loans, for most of them. They changed how they price them, how they say that lenders have to treat those mortgages. They used to be treated just like primary homes. So you just had to have a little more down payment. Instead of 5% minimum down payment, they said you had to have a 10% down payment to buy a second home. But you got the same interest rates that you would see walking around the market. I don't know how long ago now, maybe a couple of years, year and a half, they changed it to they're treating them like investment properties. So that bumps the interest rate up by about 0.75%, and you need a bigger down payment. So it's a change. Honestly, it's a very small percentage of the market right now. You can still do it, and if you're looking to buy in like the Carolinas or Florida or something like that, you can do it. But most people doing that usually do have a higher down payment, and you're probably in a position where that's more of a life decision than a money decision. You just have to get the money part to make sure it's comfortable for you.
Absolutely. I know we've touched on all this stuff, but let's summarize this. What is your best advice, mortgage advice for a buyer?
Probably three things. And I would tell any buyer this. Number one, before you even talk to me, talk to a realtor. I'm not just pandering saying this to you. It's
Sure you
working
are.
with a realtor. I mean, I would pander to you, but I don't need to. This is the real deal. Work with an agent. They have access to all the tools. They'll give you the advice. They've seen hundreds and thousands of transactions where most buyers have seen 0 to 10 or less in their entire life. There's just, you don't know what you don't know. As a buyer, you're not paying for the realtor. The seller has already agreed to list with another agent and they're paying a commission. And so your agent is going to get paid by someone else. All you're getting is the best market advice, guidance, analysis, problem solving before the purchase, during the purchase, and after the purchase. So pick somebody alike, pick somebody with experience, pick Michael Della and his team. But
Wow.
it is,
Brilliant.
you working with a realtor is by far the best thing a buyer can do to start the process. Second thing, and I'm not just shilling for myself, is get pre-approved. Whoever you want to work with. Obviously, we love to work with any buyer and do what we can to assist them. But the getting pre-approved is knowing what your options are. And there's two things that every buyer needs to know. Is number one, how much are they qualified for? Because that's your limiting factor. You shouldn't be shopping for homes if the loan can't get it done, and you don't know the factors that might hinder you. I've had CEOs come in town and be looking for their retirement home, and but they don't qualify yet is the weird thing, because they just left their job and they gave their notice and they haven't drawn up on their other assets yet. So there's a weird situation. The thing is, for most normal everyday buyers, just get pre-approved. So number one, what the limiting factor is, and then number two, what's your comfort level. Talking that through with a lender will qualify you, give you your pre-approval letter, but you also have a good idea um, about what to do, and then what your payment's going to look like. And then number three is understand that when everybody talks about numbers and everybody talks about mortgages and people, you're going to hear other people in your sphere or advice from people about, buy in this area because it's great, or don't buy now because the market is blah, 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 and they're doomsayers. At the end of the day, stop. This is a life decision. You're buying a home. This is where you're going to live. This is where you're going to spend your time. If the home, if you can picture yourself living in a home and the payment is affordable for you and it fits your life picture, that's when you know you're ready to move forward. Don't worry too much about the numbers. Don't worry too much about other people's opinions. Take your preferences, what you're comfortable with, work with your realtor, find a place, and then the lender will help you take you to the finish line.
Steve, that was just an amazing. We already knocked out an hour, so I mean, it just went by like that. And I want to thank you for doing this. It was brilliant. It was so much fun. I love catching up with you.
Well, I always have fun with you, Michael.
Sure. Just have a ball. We just get along so well. Um, before I get into a story, I want you to tell how does a buyer or an agent get in touch with you?
Oh, sure. Thanks for asking. The easiest way for anybody watching this, if my name's up there anywhere, it's my name, Steve Weixel. Just go to steveweixel.com. It's STEVEWEIXEL.com. It'll have not only my direct phone number and my email on there, it actually has an apply now button that somebody 24 hours a day can just click on that. They take about 10 minutes and submit their information. If they want to get pre-approved, mention that they heard my name from Michael Della Vella, I'll get notified immediately and we follow up immediately.
Steve, I got one more final question for you. Advice, your roadmap, more importantly, your blueprint to a young person that wants to get into the mortgage business. What would you give them as the blueprint of success?
Similar to a lot of agents, I think that I would give it advice to speak to someone like you and potentially joining a team to start, depending on their circumstance. Joining a company that can give them the guidance. Don't start necessarily from scratch. You want to be with an established lender. You want to be with somebody who's got the platform to help you, learn the business, to market yourself and, um, has the infrastructure and management available to, help you walk through transactions. Um, if you can join a high volume type situation, the situation I came from, within a realty office but you usually need a little bit of experience. I know a lot, different loan officers will join a bank because that just gives them exposure to transactions. Many of them will use an online lender, but that's actually that market has completely changed, of going direct to consumer. It's not quite as available as it used to be. Um, I would say, we're always looking for great people at guaranteed rate. But typically, like our model is really hiring experienced loan officers, people who at least have some of those transactions already under their belt. For a brand new loan officer, look for an opportunity nearby, look for somebody you know, get in there and just start doing transactions and understand that you're not going to know everything. You have to have a mentor. You have to have somebody to be able to lean on, and somebody who's willing to teach you not, both the mortgage part, because that's the first, because you need to be able to service the clients, but then all of the business management, and specifically, um, the communication with all of the other parties involved, the agents, the buyer. It's not just a function of lending; it is keeping everybody in the loop and on the same page to keep the transaction rolling smoothly. I would tell you, you have to be willing to put in the work, be willing to put in the hours, and you do have to get licensed first. But I would tell you, you can reach out to me, and I'm happy to have a one-on-one conversation. But it's a great career. It's very similar to being a realtor. It's what you make of it, and the relationships you form, and the people that you help. It's incredibly rewarding.
I tell anybody that I'm in a recruiting or thinking of doing this, it's an amazing career. It's a great life. I was blessed that it was successful. I got to be with my family. My wife was part of it. I've met some amazing friends. People I've sold houses to are on my team. People that I've sold homes to are good friends of mine. So, but I will tell people what you said. You only get out of it what you put in. Everybody wants to be successful. Everybody wants to be a big time agent and make big money, but not everyone can do it. You have to put in the time. So I love that.
It's as much it's more of an identity than it is a job. It's who you are.
Wow. It is. It truly is. Hey, Steve, when's the last time you've been to Vegas?
Oh, geez, Michael, it's been like 3+ years. I mean, with between pandemics, it's got to be pre-pandemic. Um, I'm missing the days. I was there you remember, obviously, when we were there together. When was that?
It's still
That was forever
it
ago.
was it was pre-COVID. I
That was
think so.
yeah. Now
18.
I'll tell you, I'm looking at my watch right now. I'm leaving for the airport in 3 hours. I'm going back to Las Vegas for the first time, and I'm just part of a local poker league with like a dozen friends, and
So
we do
are you going
something
for a
every
poker
year.
tournament?
What's that?
Are you going for a poker tournament?
Yeah, the World Series of Poker is going on right now.
How's
So
your
it's
game
about
right now?
Oh, I just play recreationally. I used to, when I was younger, I played a lot, and I would travel around a bit for tournaments and things like that. So I just play local league, with my buddies, and to play a tournament here and there. But me and two other guys ended up winning trips to Las Vegas. So we're heading out there for a World Series of Poker event. I can't wait.
How about our night at the Bellagio? And let's say it was 2008. It was 17 or 18. I can't remember. But
It's
do
the
you remember
best
that?
best blackjack session I've ever
Ever,
had. I really don't
ever.
play. I mean, blackjack. Yeah, I just I play poker because I like. I get the numbers, I get the situations, and I just like that whole thing. Like I'm not a slots guy, I'm not a sports betting guy, I'm not craps guy or things like that. But I mean, in blackjack, I just do it for a social occasion. But holy
And
smokes, was that fun with you? It is the most fun I've ever had
I
sitting in a
think
casino.
the way I recall it, is there was a group of us at a bar, and I kept begging you, I just want to play blackjack or cards with you. Just help me in blackjack. And it was late at night, and you just tapped me on the shoulder, and are you ready? Yeah, let's go. And it was like magical. Think about it. Think about how much goes into, you can sit at any table, but we sat down with arguably the coolest dealer I have ever met in a Vegas casino.
She was the difference, Michael. It wasn't me at all, and it wasn't you. It was her.
I lie. I'm not. I mean, you're lying, but go ahead. I'm going to tell you why it was you.
She told us everything. Anytime that we didn't do what she said, we paid for it. We were wrong. She would tell us, and I don't know how she was psychic. Somebody would sit down at the table, and she would look at you. Remember, she would look at us, and she'd say, "Take your bets down, guys. This guy's a table killer." And she said it. I mean, I remember sitting there thinking, "What's that guy thinking?" Because she just said that out loud. He can hear her. But she did it twice, and both times we bet through it and we lost during those times.
How about the streak that we went on? It was,
Michael, I remember the numbers. I remember the numbers specifically. I mean, it was so extraordinary to me that I remember it now 6-7 years later. I remember what we bought in for, and I remember what we cashed out for. And I've never seen anything like it.
And I had neither, but there was a time. I mean, again, I just was like, we were splitting aces and winning. We couldn't lose.
Could not lose.
I swear, at one point, I thought I was sitting there with Dustin Hoffman, Rain Man, because it was just like.
Do you remember the manager coming over? The manager came over and was staring at us because I think we were winning so much they had to monitor.
So much. And
I mean, we're not talking life-changing money. I mean, we're small states people.
It was fun. We're not going to divulge the numbers, but it was absolutely the most fun I ever had. And I appreciated so much that the dealer, and again, it was over an hour that we went on a streak, I think. It sure seemed.
It went through at least 2 shoes, and we could not lose. The dealer was getting pounded. And if we split and we had huge bets, they would just bust.
We would double down.
We didn't even have to worry about it.
And then she said to us, "You guys need to walk away. You're done. Don't stay with this guy. He doesn't know what he's doing. Go have fun." So what do we do? Well, first of all, we're high-fiving and we're having the best time.
I remember we bet one more time, and we lost.
We went to roulette. We went on roulette, and we both placed big bets and lost.
Right.
And we're like, okay, well, we're not that lucky. It was. I don't know if we bet on black or red, or we each picked a number. I can't remember exactly what the detail was because I was on such a high after that.
That was fun.
That blackjack
run. That was fun.
And it was legendary. And the times that I've been back, you can't duplicate that.
You can't replicate it.
Steve, I just want to thank you again. This was so much fun for me. Love catching up with you. You were an amazing person to have on this. You're so knowledgeable. You speak so well, and you really know your stuff.
A pleasure being here, Mike. I would do it anytime, and I love hanging out with you.
So when you get back, let's go grab coffee and say hi to Sherry.
I will. Yeah, we need to all get together. Say the same to Laura.
Yes.
Well, Michael, that's all. Thanks again once more for having me on. It was great.
All right, buddy. Have a great day.
You too.
Bye. Thanks for listening. I hope you enjoyed this conversation. Make sure to follow us on social media at MDV The Blueprint on Instagram, TikTok, and YouTube. We post a ton of great content. And please don't forget to subscribe to our podcast channel so you never miss out on an episode. Thanks again, and see you next time.